So, and why are we here today? We are here today to revise last semester's paper. We are revising December, April 2023 paper, AFRA paper. And what we shall do, we shall today look at the theory areas. And then, of course, next time when we arrange, I'll be able to do the computations. We can't hear. No, my sound is very good. Kindly tell that guy to get out of the meeting and then he comes back in a nice way. Because I can see my sound signal is very nice. The sound signal is very nice. Great. Thanks, Lisa. I'll be able to do that. Yes. Okay. Great. So they are talking of other. No. We have our own notes, RCM. We shall overcome. We shall overcome. Great. Thank you. Great. So then I will be able to share this screen here and go to this paper. So this paper, that is April 2023 morning paper. No, this is management accounting. No. Management accounting. I want advanced financial reporting. Yes. So advanced financial reporting and analysis. So then what do we have? Somebody here. I want to start with the easiest theory part. Easiest theory part was this question number 4. Question number 4. Question number 4. And I would want to start straight away with part D. Part D. So part D, with reference to international public sector accounting standards, IPSAS 7, investment in associate, briefly explain the accounting treatment of the investment in associates in financial statements of a public sector entity, and indicate how the requirements of IPSAS 7 compare with those of international accounting standards, IAS 28, investment in associate for commercial sector entities. So, ladies and gentlemen, remember, under IAS 28, if you can recall, under IAS 28, to account for an associate, how do we account for an associate under IAS 28? Under IAS 28, ladies and gentlemen, to account for an associate, we normally use what we call the equity method. Equity, basically, we are looking at the surplus, isn't it? Equity, basically, we are looking at the surplus. We are looking at the profit. So under the equity method, the investment in the associate, investment in any associate, in an associate, in associate, in associate. In this case here, how do we calculate this? We will be taking the cost. How much did this particular asset cost us? Maybe 10 million Kenya shillings. And then now moving forward, we are using the equity approach. So basically, we shall come and take what here plus share of PAP, plus share of what here, plus share of PAP, plus share of post-acquisition profit, share of post-acquisition profit, plus any share of post-acquisition profit, plus any share of post-acquisition profit. The equity method, equity method, because, ladies and gentlemen, when your profits in this case increase, your equity goes up. Your equity goes up. All right. So remember, investment in associates, we normally use the equity method. And this equity method, this is how you always think about it. But now remember, public sector, we don't talk of profits. Right? Public sector, we talk of what here? We talk of surpluses, isn't it? So anytime in this case here, your associate makes a surplus post-acquisition, then the surplus, you shall recognize your percentage share of any post-acquisition surplus, which you add straight away to the cost of the investment. Once you mention something like that, somebody will know straight away that this is a very good student. And then now you can go ahead to expand as per what here the examiner's requirement. Now, if you look at what I have here, ladies and gentlemen, if you look at this question number 4D. So the question asks here, with reference to International Public Sector Accounting Standards IPSAS 7, investment in associates, briefly explain the accounting treatment of investment in associates in the financial statements of a public sector entity, and indicate how the requirement of IPSAS 7 compares with those of International Accounting Standard 28, investment in associates for commercial sector entities. International Public Sector Accounting Standards IPSAS 7, investment in associate, provides guidance on the accounting treatment of investment in associates in the financial statements of public sector entities. Here is a brief explanation of the accounting treatment and a comparison with International Accounting Standard 28, investment in associates for commercial sector entities. So accounting treatment in IPSAS 7. Equity method, you can see they're saying equity method. Anybody who was able to mention equity method, and of course the equity accounting adjustments, etc., they were able to get full marks there. So the equity method under IPSAS 7, investments in associates are accounted for using the equity method. Initially, the investment is recognized at cost and subsequently adjusted for the entity share of post-acquisition changes in the investee's net assets or equity. I'm repeating again, equity method. Under IPSAS 7, investment in associates are accounted for using the equity method. Initially, the investment is recognized at cost. This is what I would want you to underline. Is initially recognized at cost. How much this investment cost me? 10 million. And then subsequently, we shall be adjusting for the entity's share of post-acquisition changes in the investee's net assets or equity. Equity accounting adjustments, the equity method requires the public sector entity to make adjustments for the share of the associates' profits or losses, dividends received, and the changes in other comprehensive income. So basically, to be very clear on this, it should be for the share of the associates' surpluses or deficits. I don't like this answer because it misses on a key thing here. It should be on the associates' surpluses or what here somebody deficits, because that's the language that IPSAS uses. Dividends received and any changes in other comprehensive incomes. That is very good, because also associates in the government sector, they normally revalue their assets. And whenever there is any revaluation in assets, that extra value normally goes under what we call OCI, other comprehensive incomes. Now, comparison, I'm just trying to answer the question in full, comparison with IAS 28. Similarly, IPSAS 7 and the IAS 28 share the concept of using equity method for accounting for investments in associates. Both standards recognize that significant influence over the associate exists and requires the investor to reflect this influence in its financial statements. Difference. There are some key differences between IPSAS 7 and IAS 28 in terms of scope, definitions, and specific requirements. Scope. IPSAS 7 applies to investments in associates in the public sector, while IAS 28 is applicable to investments in associates in the commercial sector. You are telling in this case, ladies and gentlemen, in terms of scoping of work, that IPSAS is applicable to these public sector entities like ministries, government ministries, we have non-governmental organizations, public sector, basically those sectors that are not for profit, those sectors that are not for profit. And then of course the IAS or IFRS is applicable to what we call private sector or commercial sector, etc. Definitions, the definition of the terms such as associate and significant influence may differ slightly between IPSAS 7 and IAS 28. So the definitions really here in terms of what is an associate in terms of public sector and what is an associate in terms of this commercial sector here is a bit different. Reporting requirements, IPSAS 7 may have specific requirements or disclosures tailored to the unique characteristics of the public sector. These requirements may differ from the requirements in IAS 28, which are designed for commercial sector entities. Presentation, of course, we know they are not the same. Presentation and disclosures, IPSAS 7 may have additional presentation and disclosure requirements specific to the public sector, reflecting the transparency and accountability expectations of the sector. Ladies and gentlemen, here there are things I would want you to appreciate. Basically, we are getting a situation where when we talk of these two standards under the associate accounting in the public sector and associate accounting in the private sector, we are in agreement. First of all, that we shall be using what we call what here, equity accounting method, where basically we take the cost plus any share of PAP. And if you remember, for the students that I taught here, I even gave you a formula of getting net assets. Net assets. How do we get net assets? Please remember. How do we get net assets? Is there somebody who is able to remember the equity components? Net assets in this case here at acquisition, and net assets at reporting, and net assets at reporting. Is there somebody who can remind us the net assets, the equity components? Now we are starting this class. The equity components, I show you something. Equity components, is there somebody who could be remembering? Is there anybody who could be remembering the equity components? Valentine, I'll do that, yes. They have forgotten the equity components. The equity components. Let me remind them. The first one is share capital. Share capital. The second one, share premium. They normally go hand in hand. So we have here share capital. We have share capital. We have share premium. We have share premium. We have retained earnings. Retained earnings. Retained earnings. And then we have what we call the fair value adjustments, and of course when there is any depreciation we shall be. So come here. So we have these things like that. So even if it's the government, the government doing this accounting for the associate, they'll do this, and then they'll be able to give you the total net assets at acquisition. They'll give you the total net assets at reporting. And then we shall be able to subtract these two numbers. Is there anybody who is able to remember the difference in these two net asset numbers, the changes in net assets? What name were we giving to that particular change? What name were we giving to that particular change? What name were we giving to that particular change? Is there anybody who is able to remember this really? These guys can't remember this. Remember, we are giving you this free of charge class from RCM Online College, and I would want to welcome all of you to join our online CPA classes. Should you, in this case here, be interested in joining our classes, this is our number: 555 000 0793 555 000. We charge Kenya shillings 4,200. Kenya shillings 4,200. So remember, in this case here, when you subtract these two, you shall be able to get what we call post-acquisition. What here? Post-acquisition profit. Changes in the net assets between the two time differences there is what we shall call post-acquisition profit. So if, for example, the post-acquisition profit here is 80, and then we happen to be having, say, 25% of the associate. So 25% of these is 20. So our share is 20. So then, assuming in this case here, ladies and gentlemen, we bought this associate for 60 bob, say 60 million. Then at the end of the year, for financial reporting purposes, we shall take one line in the balance sheet that we shall call investment in associate. And then investment in associate basically will be the 60 that we paid earlier on, the investment cost, plus the share of the changes in equity components, plus what we call the share of post-acquisition profit. It's called the equity method. Equity method. So up to there, first of all, are we together? Are we together up to there? Are we together? Are we together up to here? Are we together up to here? Are we together? Are we together? Are we together? Are we able to? Great. Great. It's only one student who is talking to me tonight, which is so sad, and I would really want to feel everybody here. So it's called the equity method. So under equity method, you take cost plus what here, somebody? Cost plus the share of post-acquisition profit. The government does the same. And of course, in this case here, commercial sector, under IAS 28, we do the same. However, we are saying that there are quite some glaring differences. Like the first difference is the scope, all right? Is the scope. If you read this very well, ladies and gentlemen, you'll be able to see what I'm talking about. So when we talk over the scope here, IPSAS 7 is only applicable for what here? Public sector entities. And then we have IS 28 being applicable to private sector entities. You score your marks there. And then, of course, ladies and gentlemen, we shall be having, in this case here, presentation differences. We know that, for example, under public sector, we don't even have like balance sheet. Presentations will be different, right? If you're able to mention something like that, trust you me, you will now end up getting all those 4 marks. Is there a student in this case here, to be very honest here, when you're Rambua, but you think you are able to write something like what I've explained here? Be very honest. For this part D, be very honest. Be very honest. Now they're not talking to me. They're not talking to me. Now they're not talking to me. I saw dust in the question. Great. 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 So presentation, of course, I wrote good substance, I doubt. That's why we are here. We shall overcome, Mary. We shall overcome. We shall overcome. I don't remember what I wrote. Now, ladies and gentlemen, then I would want us straight away to look at, there is a way I'll be able to know whether you wrote these things nicely. We look at the same question paper, part C, where is this now? Part C. So part C, the sole mandate and responsibility for issuing international financial reporting standards lies with the International Accounting Standards Board, ISB, the board, which in conjunction with other regulatory bodies, such as the IFRS Foundation, IFRS Advisory Council, and the IFRIC, ensure the development of global accounting standards are of a high quality. Good statement. In view of the above statement, briefly describe the procedure for developing an IFRS standard for 4 marks. Is there anybody who is able to give me this procedure? Remember, it's not like one that is cast on stone, but there are those things, ladies and gentlemen, that are quite glaring. Let me hear from you. Who is able to remember like step number 1, step number 2, step number 3, step number 4, step number 5, step number 6? Those procedures. So I'm giving you 1 minute. You give me the procedures of developing an IFRS standard. Great. Very interesting stuff, really. Okay, so I'm not seeing anybody writing really. Remember, when, for example, we want to come up with a standard, number 1, we must be able to demonstrate. It could be the IASB itself or even other stakeholders from outside here. So for example, like the insurance sector. Initially, they were reporting on IFRS 4. But now remember, we started experiencing problems with the IFRS 4. IFRS 4 presentation of insurance contracts, financial statements. We could produce financial statements and then say, you know what, like these insurance companies, ICA Lions, the profit is up there. when you're using IFRS 4. When you say profit is up there, shareholders straight away, they want a share of their profits. They want dividends. So then after paying dividends, huge amounts, and then they started realizing, hey, we have paid huge amounts in terms of dividends, but when claims of people are coming, people have got insurance policies with us, when these claims in this case here fall due, we are not able to honor. So that they started saying, hey, this profitability and especially liquidity of the farms, there is a big mismatch. So there is quite a huge complaint, huge cry coming from insurance stakeholders. So they petitioned ISB. So there must be a need, first of all, that will dictate, right, development of an IFRS. If there is no need, then So the first thing is that there must be a need. So of course, once in this case here, we get these serious stakeholders, we'll have to, as ISB, look at how serious is this thing. We can easily circulate, like for example, a document, like a concept paper. We circulate a concept paper to all our sister bodies like Kenyan accountants through ISPAC, Uganda accountants through what we call accountants of certified public accountants of Uganda. We have Rwanda, we have UK, ACCA. We circulate a concept paper. Tell these sister bodies that, you know what, we have this sector that is making this kind of a complaint. Could you kindly, in this case here, give us your input? Give us your input here. So when they give us an input, then we shall be able straight away to consider all that, and then we set an agenda. So we have what we call agenda setting. Allow me to share this for us to be able to appreciate what we're talking about tonight. So here we are. So we are saying here, it's here. The development of IFRS, International Financial Reporting Standards, follows a structured and transparent procedure. Number one, identification of the need. The process with identifying the need for a new or revised accounting standard. This can be initiated by the ISB itself or through feedback and input from stakeholders such as preparers, auditors, regulators, and users of financial statements. And then number two, we go to agenda consultations. The ISB conducts an agenda consultation to seek input from stakeholders on the priority areas that require standard setting attention. The consultation process involves soliciting public comments, hosting public roundtables, and then engaging with various interested parties to gather feedback on potential projects and their significance. So once in this case here, we are able to consult on this agenda, what I call the concept paper, at least we've been able to conceptualize, then ladies and gentlemen, we need now to adopt this and ensure that we take it as a project. So now this is a project. Now we're going to come up with the IFRS 17 for the insurance sector. All right, so project planning. Once a project is selected for development, the ISB undertakes detailed project planning. This includes defining the scope, objective, and the timeline for the project. The planning stage also involves establishing a project team. Who is going to be the team leader? Who will be sitting on this particular project team within the ISB, including technical staff and external experts to work on the standard. Now, ladies and gentlemen, the very first thing this team will do is now to produce what we call a detailed discussion paper, a DP, discussion paper, or exposure draft. The ISB develops a discussion paper or an exposure draft depending on the stage of the project. A discussion paper is a document that presents the ISB's preliminary views and invites public comments to gather input on the issues and potential solutions. An exposure draft is a more mature document that proposes the actual changes to the accounting standard and seeks public feedback. Now, ladies and gentlemen, please listen and listen to me very well. Remember, up here, we had started with a concept paper. We've been able to constitute a team. So this team now will be able to work on a paper that now will be developed by ISB. What basically I could call like a proposal in terms of thesis language, a proposal. which is an exposure draft that we shall be able to expose to the various now stakeholders, actually the public. Discussion paper or exposure paper draft. The ISB develops a discussion paper or an exposure draft depending on the stage of the project. The discussion paper is a document that presents the ISB's preliminary views and invites public comments to gather input on the issues and potential solutions. After that, ladies and gentlemen, now the paper is hung somewhere on the website of ISB. So once you put it there, then now we are inviting the public to give us their inputs on this exposure draft. So public consultation. During the consultation period, interested parties are invited to submit their comments on the discussion paper. Ladies and gentlemen, this thing is exactly similar to, for example, this financial bill 2023. So that at least I can diffuse some tension. Because I can see some of you really worried. Yeah. What do you think of this finance bill 2023? Should it pass the way it is without even a comma being put or removed from the document? And I would want in this case here to break the ice. I want to break the ice. What do you think of this finance bill? Is it a good thing or bad thing? And why? Someone type there something very fast. You're an accountant. Hey, you know, even in your church place, for example, people will come for your opinion about this finance bill. What do you tell them? What do you tell them? What do you tell them? Because like now, people really, various stakeholders have been given a chance to present their memoranda, right? And you don't just go to that body there and then you say, I'm against the bill. You must give us reasons. You must give us reasons. So the same case here, public consultation, public engagements. During the consultation period, interested parties are invited to submit their comments on the discussion paper or exposure draft. The ISB actively seeks feedback through public hearings, roundtable discussions, and written submissions. The comments received are carefully considered and analyzed by the ISB staff and the board. So in this case here, the Ruto's government, do you think they are going really to take the feedback from the public seriously? I guess no. So this one basically is a flowery exercise. If it's ISB, they have their technical staff who will go through all the memoranda given. All right. So from there now, of course, they take this thing back, deliberations and re-deliberations. The ISB holds deliberations to consider the feedback received during the public consultations. The board discusses and debates the various issues raised, considering different perspectives and alternatives. Deliberations involve refining and revising the proposed changes based on the input received. From there now we have the concept of now, after they have done the final revision, publication of the IFRS standard. Once the deliberations are completed, the ISB finalizes the standard. The final standard is issued in the form of an international financial reporting standard. The IFRS sets out the requirements and the guidance for financial reporting in relation to the specific area addressed by the standard. And then, of course, they will be able to define the effective dates and what transition requirements do we have, and are you allowed, for example, to do early adoption? Effective date and transition. The ISB determines the effective date of the new or revised standard. Entities are typically given a period of time to implement the changes. The ISB may also provide transition guidance and practical expedients to assist entities in the implementation process. So, ladies and gentlemen, that is what you are required to have done. That is what you are required to have done. Is there somebody who was able to, okay, of course they don't have to be like exact, but were you able to give an answer that you think is quite close to what we have there? And this keeps on coming, like every semester they give us this thing. If I were you, I would master this. Almost every semester it is there. And remember this theoretical question. Anybody who got like 16 or 18, straight away, the doors of whichever were open. Now the problem, these guys are not talking, and because they're not talking, I think they are in celebrations mood. I would want to give them a break, and then we shall agree we continue maybe on Sunday, same time. Is that okay? Even that is when I'll be able to get the number that I desire. This number 30 is who teaches 30 students. We got out of this kind of an arrangement long time ago. I teach 200. So of course, ladies and gentlemen, then I would also want to invite you guys to join our AFRA classes. Don't make that mistake of saying that you will study on your own. You can't study this thing on your own. You still need guidance. So of course, if you're interested, this is our number. How much are we charging? We are charging 3,200 Kenya shillings for those in this case here who are doing a retake. A retake is 3,200, and you must provide a proof that for sure you failed. You simply send us a message, like somebody sent us a message that I have failed this paper. Then we confirm with KASNEB. Very easy. It's just a phone call away. You confirm. The moment in this case you give us this 3,200, we shall be able to give you access to all our Zoom materials all the way up to the end. And then now we have our pay bill. Yes, our pay bill is 6242,839. Account number is your papers like that, like AFRA, etc. And then of course you send the payment message. You send the payment message to who? To 0719 525,000. So should we meet on Sunday for the same, ladies and gentlemen? I would want you guys to really get out of your way to engage in discussions. That is what I've missed today. Today I'm not getting so much discussions really. I'm not getting so much discussions. Great. Yeah, retake means you sat for the paper, right? And you failed. You sat for the paper and you failed. Then we shall be able to allow you to do what here? To pay the 3,200. Otherwise, our normal fees is 4,200. So our aim is to ensure this time around I will be more involved in AFR more than I have been before. I'll be more involved. Actually, I'm going to discuss with our great teacher so that I can get one permanent session where I'll be able to come and have my own, especially my strongholds, where I've assisted so many students in the past in AFRA, is the theory areas. If I teach you the theory areas and you're a serious student who is basically quite busy whenever it comes to discussing, it is not about theory, is not about you just taking note. You must give your idea. So you type, you say, this is what I think, like that. And then we shall be able to pass this thing round 1. Or if it's a retake, this August session, we should be able to overcome. So physical class cannot be 3,200. Physical class, you'll be able to do what here? You will be able to discuss with Mr. Kyoko at RCM Standbank. Physical class, physical class, there is a lot of rent being paid over there, right? So, but we should be able to adjust something. It's not 9,000 per subject. So I think retake can give you a discount of 1,000. Valentine, we shall overcome. Revision videos, remember again, once in this case here, you pay as you join the normal classes for AFR, you'll be joining the normal classes. That is for sure. But once you join the normal classes, what we have done, we have now developed a very nice learning management system. A learning management system, right? Where we are putting inside there, I'm actually almost at a place where could talk of say 70-80% complete. By Monday, we shall be launching this on Monday. So once you are in our normal classes without adding any fee on top, you will be able to get access to our learning management software where you'll be able to get notes and highly summarized videos And the videos, of course, you'll be able to see most of them are what year revision. And this, I'm the one who has done all these videos personally, all of them. If you like just in case you like my teaching approach, then you'll be able to benefit out of this. All this for just Kenya shillings 300. You can't get any better deal than that. Otherwise, asanteni sana. It's a lot. You see, currently, Monica, okay, great. So currently, how many sessions do you guys have? You guys have 3 sessions. So then what I'll do is to introduce the 4th session, and now this becomes mine for purposes of, remember the topics I normally teach. I normally teach group consolidation, group cash flows, and then all the theoretical areas, IPSAS, talk of IPSAS 9, talk of IPSAS 23. Like IPSAS 9, IPSAS 23, that now will come in August, August sitting. They'll test you the difference between IPSAS 9 and IPSAS 23. I really love that. I wish I was an examiner. I would have set that one. IPSAS 9. Remember IPSAS 9 in the NGO world? We are talking over revenue from exchange transactions. These NGOs like United Nations, these guys also do business. Whenever they do business, they get revenue. So when they get revenue out of doing business, then that will be accounted under IPSAS 9. Revenue from exchange, they've done some work to earn that income. But there is some big chunk of their income which is normally given to them for free, donation. So if it's a donated revenue, then that will be accounted for under IPSAS 23, which is revenue from non-exchange transactions. Once you are aware of those things, trust you me, AFR will be a walk in the park. You like the subject. AFR is not just about number crunching every day, it's about deferred. No. AFR has got more than that. The qualitative aspect. These theory areas are rich. They can make you see places that you've never seen before. Great. Unfortunately, Lucy, we don't have that per lesson payment. So perhaps you can just get in touch with me and then we'll be able to structure like a payment plan with you. My number, if you would want to talk to me directly, Lucy, my number is 0721 620 183. I prefer WhatsApp messages. That easier because when I'm teaching, I may not be able to receive your call, but later on when I see a WhatsApp message, I'll be able to reply, and then we enter into some payment plan. And by the way, this 3,200, you can also pay it in 2 installments. You don't have to pay it. No. It's on offer, by the way. That 200 is on offer. So if it's on offer, you should have paid by, is it the 4th? In full for you to consume the offer, yes. So that one cannot be having any payment plan. If you want to pay in installments, and you pay 4,200. Thank you so much. Great. Be blessed. Big time. Thank you.